Hey everyone, Erin Stabb here, your New York City real estate expert. Today, we're breaking down one of the most common questions that I get asked. How much money do I actually need to make to buy a home in New York City? Buyers often think that if they earn a healthy income, that they won't have any issues buying an apartment. But there are a lot of factors that go into your buying power, as well as building requirements that affect your affordability. This may seem overwhelming, but don't worry. I'm gonna walk you through the financials step by step in simple terms. We'll cover what affects affordability, how to estimate what you can afford, and I'll even show you what that looks like with some real apartments currently on the market. And make sure you stick with me until the end. I'll be sharing a bonus insider tip that most first-time New York City buyers don't know until after they've lost out on their first offer. What affects affordability? Let's start with what really determines how much home you can afford, because it's not just about your salary. Here are the main factors. First, interest rates. Interest rates continue to be all the buzz these days. Obviously, the higher the rate, the higher your monthly payment. But your rate can be adjusted up or down based on your credit score, how much money you're putting down, for example, 10 versus 25%, the type of loan, a 30-year fixed rate versus a 15-year ARM, and relationship pricing. What's relationship pricing? That's when a bank gives you a discount on your interest rate for banking with them. The larger the amount of money you move over to their bank, the bigger the discount. All of these things can significantly impact the interest rate on your loan, moving the needle on your budget hundreds of dollars a month. Next up, let's dive into something called DTI, debt to income ratio. Lenders look at your total monthly debt compared to your income. They usually want your total housing costs, mortgage, taxes, insurance, and common charges, along with other debt like a car payment, to stay below roughly 43% of your gross monthly income. But the more important thing to consider with DTI is what a co-op that you want to buy in requires. The majority of housing in New York City, and that's Manhattan, Brooklyn, and Queens, are cooperatives, commonly called co-ops. Each co-op has a different set of requirements, but a good rule of thumb is that they want to see that a buyer has a DTI of 28% or less. So let's give an example. If the apartment you want to purchase has a monthly maintenance fee, which includes taxes, of $1,000, and your projected monthly mortgage payment is going to be around $3,500 a month, and you have no other debt, then your monthly debt total is $4,500. If your gross monthly income is $17,000, then your DTI is 26.5%. That's under the 28% threshold. If you want a deep dive into co-ops, check out my video, Unlocking the Secrets, your guide to buying a home in New York City. Let's keep things moving with down payment. The more you put down, the less you borrow, and the lower your monthly payment. In New York City, many co-ops require 20% down. Some even require 25 to 30% down, while condos often allow as little as 10% down. So why is this important? Well, for two reasons. First, you might not have a large enough down payment to buy in a co-op if they're requiring 25 or 30%. And second, because if your DTI is borderline, let's say at 29 or 30%, by putting down more money, that will reduce your monthly mortgage payment and reduce your DTI. Let's give another example. On a $600,000 purchase, if you put down 20%, you're looking at $3,000 a month in mortgage payment. But if your DTI is a little high and you have the funds available and can put down an extra 5%, that will lower your monthly mortgage payment by almost $200. And that could be the difference in lowering your DTI to an acceptable percentage. Let's jump to your credit score, as I touched upon earlier. Better credit equals better mortgage rates equals lower payments. It's that simple. Lastly, let's talk about taxes and common charges. In New York City, remember, you're not just paying for the apartment, you're also paying for property taxes and common charges that go toward maintaining the building. That's for condos. For co-ops, your taxes and common charges are lumped into one number, and we call that your monthly maintenance. These vary a lot by building. You could be considering two similar apartments, one with a monthly maintenance fee of $800 and the other $1,200. That $400 difference is huge when it comes to calculating what you can afford. That brings us to our next point, how to calculate affordability. So how do you figure out how much home you can actually afford? Let's break it down with an example. Say you earn $150,000 a year. That's about $12,500 per month before taxes. If we assume you keep your total housing costs under 40% of your gross income, that gives you roughly $5,000 per month to spend on your mortgage and monthlies. That may be fine for a condo, but if you want to buy in a co-op, you'll need to keep your total housing costs under 30%, which gives you less than $37.50 a month to spend. Wow, that's a huge difference. At today's rates, around 6%, and assuming a 20% down payment, that means you can afford a home in the $650,000 to $800,000 range, depending on the apartment's monthlies and whether you're buying in a condo or a co-op with specific financial requirements. Now, if you put more down or find a lower rate loan, your purchasing power goes up. If you've got more debt, like student loans or a car payment, it goes down. That's why it's so important to look at your whole financial picture, not just your paycheck. I can't stress that enough. Now let's look at some local market examples. Let's see what this all looks like in real life. Let's start in the Upper East Side of Manhattan. For around $800,000, you can find a one-bedroom co-op and a full amenity building, something like this, with close to $1,500 a month in maintenance, with a 20% down payment and a 6% interest rate. You need to earn over $200,000 a year to afford this apartment. Now, that may seem like a lot, and it is, but this is the reality of New York City real estate. Let's jump over to Brooklyn for another example. Let's use a $600,000 budget. In Bushwick, you can buy a brand new one-bedroom condo like this one with only a 10% down payment, and you'll only need to earn roughly $130,000 to $140,000 annually. That's with monthly taxes and common charges right around $1,100. Remember that with a condo, there's no DTI requirement like you'll have in a co-op. For our third example, if we head to Queens, for under $600,000, you can find a spacious two-bedroom condo with lower monthly fees, and with a 20% down payment, you could qualify with a salary closer to $120,000 a year. As you can see, affordability really depends on the neighborhood, the type of home, the monthlies for the apartment, and your personal finances beyond just your salary. All right, you guys ready for a bonus tip? In New York City, a pre-approval letter often isn't enough. When you're competing with other offers, sellers, especially of co-ops, want to see pre-underwritten buyers. So having your lender verify your income and assets upfront and have them approve the building ahead of time, these extra steps can make your offer stronger and get you the apartment you want. So how much money do you need to make to buy in New York City? There's no single answer, but now you know how to break it down. If you're thinking about buying, talk to a trusted lender in New York City or reach out to me. I can help you understand your numbers and explore apartments and neighborhoods that fit your lifestyle and budget. Don't forget to like this video, subscribe for more New York City real estate insights, and comment below if you want me to do a breakdown for your specific neighborhood. I'm Erin Stabb. Thank you for watching, and I'll see you in the next video.